Welcome, welcome, welcome. Great to have you guys here. Thanks for tuning in. I'm Rob Tetrault from robtetrault.com, portfolio manager here, Canaccord Genuity Wealth Management, and at the Tetrault Wealth Advisor Group. Monday, November 9th, 2020, I believe has been our greatest day of the year in the stock market, or one of, definitely. A huge update today, up 1,200 points, just a gangbusters day in the market. The market loved that Biden election and the Senate staying with the Republicans. The market loves that. Market loves the Pfizer news that came out where looks like 90% efficacy on a vaccine. The market loves this potential future stimulus package that is coming. All in all, this was fodder for a market that went gangbusters this morning. Fun times. Let's bring in our guest today. I'm really excited about our guest. She's got a fantastic following on YouTube. She's actually done it. She's one of those wealth mentors that not only has put her money where their mouth is, but she did it. She went and she built her own investment portfolio, her own real estate portfolio, independently wealthy at a young age. We're thrilled and lucky to have her here. Let me bring her right in. Tiffany Thomas, wealth mentor. Thanks for being on the show today.
Yeah, thanks, Rob. I'm excited to be here.
All right. So for those of you who don't know, this is a poppy. This is in honor of Remembrance Day. Tiffany, you're American. You probably don't celebrate a Remembrance Day like we do, but that's for November 11th. That's to remember the veterans that have fallen. So holiday coming up this week here in Canada. You're in the US. You're in Utah. Do you follow the markets closely? Did you see what happened today in the markets?
Yeah, I did check a little bit earlier today. So exciting stuff. Yeah, the US election has an effect on the stock market for sure.
I woke up this morning and the futures were up 1,700 points when I woke up early this morning. And I was like, 1,700 points, that's got to be a typo. That happens from time to time in the markets where you get up days that are like 5%, but you don't often get up days that are 5% unless you've had really bad days before, right? We've not really had a bad day. We're close to the all-time high. I would venture to guess that this is the first time we've had, a 1,500 point intraday gain to make an all-time high in the stock market. I'd venture to guess ever. I bet you this is the first time this happens ever. I don't know that. Also, the NASDAQ, I don't know if you followed this. Anyone at home's followed this. So the market kind of fell towards the end of the day and finished up about 800 points, but that's about 3% on the Dow. If you're following the Dow, the S&P 500 is up about 1%, but the NASDAQ was actually down. So those of you who own tech stocks, NASDAQ ended up down about 1.5%, which is something that you wouldn't expect given the sheer volume of positive buyers that came into the market today.
Yeah, it was true. I was surprised to see that.
And I mean, some of the names is crazy because, you look at the names that did well today, it's all the reopening stuff. So the COVID stuff, the travel stuff, American Airlines, the casinos, some of the banks, some of the REITs, and some of these cruise companies, they've all done really well. They're all up 10, 15. Some of the airlines are up 30%. The worst performing stock, or one of the worst performing stock today, is Zoom. Zoom is down, almost 20%. Netflix is down, Shopify is down, Telco Health, Wayfair, all these kind of COVID names. The irony in all this is that, the money that you've made over the last 6 months investing in Zoom and Wayfair and all these companies, today was the reverse. Today was the losers that came to the forefront, and they're up big. So really interesting day. I'll just say this before. I do want to ask you a bunch of questions about your wealth, because I think that's it's a phenomenal story that you do have, and some really good advice that you do have for our viewers. But your story, takes us back to, this story today that we're talking about, which is the reason that people diversify, right? If you own nothing but tech today, you're down today. But if you had some sort of diversified portfolio, you would have done well. So I'm always a preacher of diversification. I do believe in tech. Amazon and Google were two of my all-time favorite names, as I told you earlier, but diversification, that's what we would preach. And you've done some of that in your own wealth investing. Tell me how you started out. Where does the story start with you becoming a self-made millionaire on your own?
Yeah, so it started quite a while ago. I had a friend who was really successful investing in real estate and the stock market, actually. And so I just kind of started talking to him and asking him some questions, and he actually helped me purchase my first property because I asked him so many questions, and he kind of helped me through that process. But that was back in 2005. And so that was the first property that I owned. And then I got roommates so that they could help pay the mortgage. And then I was really good at saving my money for a long time, but I knew that I needed my money to start actually working for me instead of me always working for my money. And so I ended up buying a rental property quite a few years later in 2015. And I also had a boss that I was working with that was really successful in real estate. And so I asked him a bunch of questions along with my friend, but I ended up purchasing that second property, and that was doing really well. And so I thought, you know what, I want another property. And so the next year I purchased another one, which I ended up moving into and leaving my roommates at my old place and getting roommates at my new place. And then I ended up purchasing a fourth property in 2018. So I have the four properties, and I started investing a little bit in the stock market. And then as I started to see the returns that I was getting, and kind of like we talked about before, some of those tech stocks did really well. And so I was investing in some individual stocks like that, and then also just an index fund that follows the total stock market. And I started to see really good returns on that. So when I bought my last property, that fourth one, I ended up taking a bunch of money out of my stock market investments and putting that toward the down payment for that property. But yeah, it was just, kind of that shift in my mindset of I really need to make my money work for me and not just keep it in a savings account where it's not working for me at all. And then just kind of having a couple of mentors along the way to see, how they were able to do it, and just realizing, okay, yeah, if other people are successful with this, I can be successful with this too. And then also a part of that journey was finding the FIRE movement, the financial independence, retire early. And when I saw that people were retiring early in their 30s or even 20s or 40s, I thought, what? Like, how are they doing this? So when I did a bunch of research and just started looking at how other people were doing that, I ended up quitting my job at 36 and starting my own business, my wealth mentoring business. And just became financially free, and I hit the millionaire mark earlier this year, which was super exciting. But that's kind of, a short version of my story.
Nice. That's a neat story. So when you start out, so if I'm a viewer out there, I'll say, well, how were you affording the down payments? You were basically, your strategy was to accumulate, save as best you could, just enough for a down payment, right? Or were you taking it out of the equity that you had in your first property?
No, so it was just saving enough money. Yeah,
Saving.
I was, I was really paying attention to my expenses and what I was spending my money on. And I was able to save enough for a down payment for that first property, and then again for the next two properties.
So what percentage, how much percent down did you put on your first property?
It was less than 20%. I want to say it was probably 10%.
10% down. Okay. So you bought is it fair to say you bought like $150,000 home or $200,000 home, and you put like 15 or 20 grand down?
It was actually just 130,000. So it was a townhouse.
Okay.
Yeah. So I was able to put down just that 10%.
Okay. And then 10 years later or so, when it became time to buy your second one, obviously you're paying a bit more, but you're still doing the 10% down.
I actually did 20% on that property. I just bought it strictly as a rental, so I had to do the 20% down.
Okay.
Yeah.
So now you had cash flow. Were you cash flow positive on that property?
Yes.
Okay. So you're cash flow positive right away on the property. So in addition to paying down the mortgage every month, you were actually getting a little bit of cash from that. That was a duplex or something like that? It
was a condo. A 2-bedroom, 2-bath condo.
Nice. And that was in or around Salt Lake City, if I recall.
Yeah, that's correct. Yeah. Just right outside Salt Lake City.
Okay. So then you bought a third one. Third one, again, you have to get 20% down.
Since I was moving into that property, I only had to get 5% down for that
5%.
one.
So that's kind of what I'm getting at, is that there's different
Yeah.
strategies. And I know the rules in Canada and the US are a little different, but in Canada, we have, where we can get CMHC insurance with respect to the amount of the down payment, and you can just kind of tack it on. So if you don't have 15 or 20%, you can kind of buy with a smaller down payment, provided you're willing to just pay more over the course of your mortgage. But in the US, it's just, if you move into it, you could have less. And if you don't, you need to have more. Is that correct?
So if you have 20% down, then you don't have to pay, it's called private mortgage insurance,
Yeah.
PMI. But if you have less than 20% down, then you have to pay that extra charge.
Right. And do they tack it onto the mortgage?
They do. Yep.
Yeah. Okay. So it's exactly the same thing as in Canada. Okay. Now, you've not used your equity out of the actual properties that you've bought yet to build this wealth, right?
Right.
So these mortgages come up for renewal every 5 years, I would imagine. Is that what you've been doing with the debt?
So it's a 30-year mortgage that I took out on all of them.
Right. So 30-year amortization and terms are locked in for 5 years, or do you just do like 6-month renewables, or how do you do it on the debt side?
So it's a conventional loan. So you can just keep it for 30 years and have that same payment the entire time. Is that what?
You've locked in the rate for 30 years?
Yes. Uh-huh.
Oh, wow. That's different than Canada. You could never do that in Canada. Okay. So what kind of rate do you get on a 30-year mortgage right now?
Right now they're super low. I've seen them from like 2.5% to like just over 3%.
Okay.
So yeah, they're really good rates right now.
What happens if you either sell that piece of real estate, or if you want to pull equity out of it?
So you can refinance, and that way then you would have a new rate, whatever the current rate is. So you could refinance for another 30-year mortgage, and use the equity that way to buy another property. Or
Okay,
do
but
whatever you want.
and you can do that at any time in the US? There's a fee, there's a penalty, or there's got to be a fee or a penalty, I would imagine.
Yes. Yeah. So when you refinance, there's closing costs associated with it. So it's not, just like switching right over or anything. There's extra fees.
So what we typically see here in Canada is someone will typically take a 30-year or 25-year amortization, but with a 5-year term. So that at the end of 5 years, you can either choose to go with a different institution, you can choose to change the terms, or you could choose to refinance at that point. So you kind of get you reset the clock every 5 years, however you want to do it. Some people do it on a 1-year rolling basis. Most people do it on a 5-year rolling basis. So that every 5 years, if you wanted to, if you've built equity, if you've bought a piece of property in an area that is booming, well, then, maybe you bought it for 500, but it's worth 700. Well, now you've created 200 grand of equity, right? So if you refinance that in 5 years, now you can pull that out and potentially buy another rental that you were referring to. But that's not what you've done. You've done it with your savings.
Right. Yeah. And there are other loan options in the US kind of like that would reset after 5 years. Yeah. Or you would have a higher interest rate at the end of 5 years. But mine was just conventional loans.
Straight conventional 30-year mortgage. Okay. So I'm a big believer in, if you do have equity and if you're actually using that equity, in a healthy way. So for example, not spending it on a trip or not spending it on a motorcycle or something. If you're actually spending it on another piece of real estate or another investment, I believe it makes a ton of sense to leverage that equity that you've created and in an asset that you live in, provided you understand the volatility and provided you understand what you're actually doing with the risk. I'm a big believer in doing that. What's your take on that, on taking the equity out of your piece of real estate that you own to leverage and to use to buy another piece of real estate?
Yeah, I think that's a great idea as long as you're not getting over leveraged. And like you said, if you're smart about it, not, blowing that money on a trip or whatever. So I think that can be a really good strategy, especially if you want to accumulate quite a few properties. I didn't want that many properties, so I decided not to go that route. But I think, that can definitely work for people. Just making sure they're not over leveraged or too tight with their mortgages.
Do you pay someone to manage your properties, or do you do it on your own?
I do it on my own. Yeah, I'm my own property manager. So I get random phone calls or things that need to be fixed. But it hasn't been really bad and I don't mind doing it. So I have a handyman that I work with. I don't fix everything. So when something does go wrong, I'll reach out to my handyman and say, hey, can you go over to this property? And I'll pay him for that. But
Okay.
yeah, I do manage them.
What about for most people out there? Do you think it's a good idea for them to get a property management company, or do you kind of suggest when they start out, like 1, 2, 3, 4 houses, for them to do as much as they can, as much of it on their own?
I think, yeah, if you're just starting out and just have maybe one or two and you have the time to do that, I would say you can definitely manage your own properties. But I mean, if you are super busy and working more than full time, then yeah, for sure, get a property manager and let them handle all of those details. So it kind of depends on your situation, I guess.
When you're buying these houses, what are you looking for specifically when when you're buying these? Is there a multiple of revenue relative to purchase price? Is there a magic formula, or is it just, this looks like a nice place that I think it's worth more than this, I can get it for less?
There's not really a magic formula. I just look for properties in good locations that I think that those places will kind of grow over time and they'll continue to kind of be a good place to live. And then I look for properties that are a little bit newer and not super new, but since I don't want to be doing a bunch of remodeling or things like that, I like properties that are move-in ready and I can immediately start getting that cash flow. And then I just look in the area and see how much rent prices are and just make sure that my numbers work out so that I can get a positive cash flow from those properties, knowing that they're in a good area. So they will appreciate over time and the rent prices will continue to go up. So I'm not buying in, I don't know, lower cost of living areas where I'm going to be worried about renters paying rent.
Yeah. All
So
of your renters are on like automatic mortgage payments, I would imagine, or pre-author or post-dated checks or something like that.
they're actually not. So I rent to, the majority are single women. So a lot of them actually just pay me through Venmo, but I do a background and a credit check. So I know I've been fortunate to have really good tenants. I've only had one that hasn't been that great out of like over 40 tenants or something. I don't know.
What would
So
you,
yeah,
what would you say is that kind of the biggest thing you look for when you look in tenants, is kind of character?
yeah, it is. I like going and meeting the person. That's kind of why I don't, part of the reason why I don't have a property manager, because I want good tenants. And
Right.
if I can go and meet the person and kind of get a feel for how they are, then yeah, I can kind of tell, yeah, I think she's going to be good and she'll pay her rent
So
or the opposite.
take me through the math, and I think I know how it is, but take me through the math anyways when you're buying a property. So you're basically going to take $200,000 or $250,000 condo. You're going to say, I'm putting 10 or 20% down. What's the mortgage that's left? You put that on the mortgage calculator on a 30-year amort at 2.59%. You get, $1,500 mortgage payment. And then you tack on I imagine your taxes and your insurance.
Mhm.
And then you hope that you're cash flow positive. What kind of cash flow positive number do you need to see on something of that size for you to consider purchasing that?
It would just be maybe like $200 or $300, not that much, because I know it'll continue to appreciate over time and it's paying for itself anyway. And I kind of allow for, expenses, if something needs to be replaced or fixed. There's maybe like 5% or so that I'll allow for that. And then also the HOA fee for a condo or a townhome.
Right.
And yeah, but yeah, it's not a huge amount. And the reason is because, like I said, the property continues to pay for itself. And then one day it will be paid off and I'll have a huge amount of cash flow because I won't have a mortgage payment anymore.
Well, or you'll continue to use that equity to just add to the portfolio, right? You'll
Or that.
just pull more money out, buy more properties, pull more money out, buy more properties, and multiple
Right.
using someone else's cash flow. Is there a number that when you said early that you didn't want to see someone over leverage themselves, is there a number that you can think of off the top of your head that would be too much leverage for anyone? Or do you suggest they get as much leverage as they can when they're buying real estate?
I guess there's not really a certain number. I feel like they just have to feel comfortable, especially with the pandemic this year and a lot of people not paying rent, I feel like those that were over leveraged are going to be struggling or are struggling. But I don't really have an exact number for someone. It just kind of depends on their situation, how much they have in their emergency fund, or how much how much cash they have access to, if they can pull out investments or things like that. But it kind of just depends on their own situation and their own comfort level, I guess.
Yeah, there's kind of 3 or 4 ways really where in theory you're going to make money there. One, you're going to make money with the cash flow. You're positive on your cash flow. 2, you're going to be paying down that equity, that mortgage down month by month over 30 years. 3, if you believe in real estate growth like I do, and you obviously do, then your $250,000 condo will be 275 and 300 and eventually 500,000. And 4, do you do any kind of renos in there to try to improve the return, like the rent, or do you try to kind of get the rent up, or are you kind of focusing on the first 3?
I have remodeled my 2-bedroom, 2-bath condo a little bit ago. And yeah, so that I could raise the rent. It hadn't been updated since it was originally built. So I did do some updates there in the kitchen, and I did new flooring and new vanities and stuff in the bathroom. So it wasn't like a major rehaul or anything like that, but it was updated enough that I could raise rent. So I did do that with my condo, but the other properties are pretty nice. So I haven't done any updates. I mean, I've painted, but nothing major.
Okay. So if someone's coming up to you and asking you for advice, so you do mentoring. If someone's coming up to you and asking you for advice as to whether or not they should rent or buy, what would you advise them?
So I would ask, I guess, kind of what they're looking for, because just having a house isn't necessarily an investment, because there's a lot of expenses that come with a house. But if they are looking to buy a house, maybe with a mother-in-law basement apartment, or if they're going to rent out some rooms or something like that, where they could create some extra income from that property, then that would be a good route to go. But I also ask them what their goals are. Like, if they really want a place where they can settle down and raise kids and not have to worry about moving, then a house could be a good choice for them. So I kind of just get a feel for what their goals are, and help them realize that buying a house isn't necessarily just a good investment, because of all of the costs that are associated with it. But if it goes with their lifestyle and they don't want to have anyone renting out a room or anything like that, then then that goes with their goals and their lifestyle. So it could be a good purchase for them, and it probably will appreciate over time. So there is that aspect. But yeah, just kind of getting a feel for what their goals are and what they are looking for in investments.
I remember my parents used to always tell me that buying a house or buying a condo or buying a townhouse or whatever was not only a good move financially, but it was also like a game changer for any young adult that decides to do that, because that at that point, they have added responsibility and added, they have payments that are due, and they actually start becoming, or I guess they finalize the portion of their maturity into adults, and it just kind of changes you as a person for the positive, right? Like you're going to take care of your own place because you own it and you're paying for it. So you just kind of develop these good habits. And my parents used to really, really preach that it was kind of like a turning point in your life when you kind of bought that first property, because now, you've made it, and now you're going to take care of this place.
You're an adult.
You're an adult. Yeah, you're an adult. Absolutely. So what about the ones that are a little lost? So a lot of younger people, I know you mentor a lot of people. So when it comes to managing their finances, a lot of people are lost. Why do you think that is? And then my next question will be, where do you think they should start to try to kind of get out of that rut that they might be in?
Yeah, so I think it kind of just starts with the lack of education. They haven't been taught these things in school, and maybe their families or their parents didn't have the best, financial advice to give them, or financial examples. So I think that lack of education is where a lot of this comes from. And, if we can just start really small with that education, and depending on where you are, whether that is learning to pay off some debt or learn how to get out of debt or just become more conscious about what you're spending your money on and set some goals for yourself that you can work towards, some financial goals. But just kind of starting small and just one step at a time so it doesn't feel overwhelming and then they don't take any action whatsoever. But yeah, just kind of educating yourself. And, I have plenty of YouTube videos about, learning to just manage your money better, or learn to start investing. And if they can just start, with that educational piece, I think that becomes really beneficial because then they're learning actually how to manage their money better, and they can apply what they're learning and start to save it and invest it, and eventually become financially free.
I've been pounding the table on that point for years, that in Canada, we need to do better at educating our high school students and our young adults, kind of the basics of finances and saving and leveraging and borrowing and what's a mortgage, and, how to make an RSP contribution or a 401k contribution, what that means. And it's just, I feel like we're so far removed. Like, we get kids that understand every single aspect about, 10 or so important subjects in high school. And yet what I think is an incredibly important one where a lot of people suffer, like financial literacy is a huge problem. And we put like zero efforts into that. That's the similar in the US, I would imagine?
Yeah, it is. And I hope it's changing for the better. I mean, I've heard some different programs that might be coming into place and things like that. But yeah, it is lacking. And it's so hard to see that because it's so important. Money is with us our entire lives. So we really, really need to get a handle on it.
I'm Rob Tetrault. I'm here with Tiffany Thomas. As a reminder, if you're watching on YouTube or on LinkedIn or on Twitter or on Instagram or on Facebook, please take a sec to subscribe, like. If you've got any comments, please send them our way. And if you'd like to book a no obligation consultation with two thumbs, this guy, Rob Tetrault, go to www.speaktorob.com. We'd be happy to book a no obligation consultation. Hey, Tiffany, I want to ask you about the decision for most people to leverage. Let's talk it through here, why an investment makes sense in real estate. Then I want to ask you a question about whether or not you would invest in a publicly traded real estate investment trust, or if you found that to be, or if you prefer to, my understanding is you probably prefer to own the asset yourself. But if you're buying real estate, you're using 10% down, you're leveraging the entire amount, you're basically hoping that the small amount that you put down and the larger amount that you borrowed, the cost of borrowing on that is so low right now that you hope you'll compound it faster by owning the asset yourself. So a lot of these publicly traded REITs, they exist on the stock market in the US and in Canada. They do the same thing. They go out and they buy real estate, and they manage it for you, and they kind of do it all hands off. So what would be your advice to someone who would argue with you that instead of going out and buying 4 or 5 or 6 different rentals, why wouldn't I just put that money in the market and let the professionals do it?
Yeah, I like investing in real estate, and I've seen what it can do for me and for other people as well, bringing financial freedom. So if you can just leverage that little bit of money, that down payment, and borrow the rest of the money from, a lender, from a mortgage company, and you can start to create that immediate cash flow from your property. And also over time, it will appreciate. So for me, I like that physical asset. And, like we've talked about throughout the show, you can continue to leverage over time. And, if you want to take out some of the equity from one property and put it into another, you can do that. And I don't know, for me and the people that I've seen be successful with this, the physical real estate it's been a game changer. So, if I can see, if you, I guess, just want to keep it really simple and do a REIT and not worry about the physical asset, I can see, where that could be a good possibility for some people. But I have just seen that value in real estate, and it's a complete game changer. So I just love investing in the physical real estate.
Yeah, no, and I think you're preaching to the choir because, I also own some real estate. My parents own real estate, my grandparents own real estate, and kind of been a big theme in my family as well. And I totally see it. But I think you touched on two things there in your answer. The first thing you said is leverage, right? If I buy a publicly traded REIT, most of those are only leveraged about 50% or even 40%. So, you need a lot more capital to buy that same building. Whereby, you and I, if we're buying real estate, we're going and we're leveraging 90%, right? We're borrowing 90 cents on every dollar or 80 cents on every dollar. So that's one big thing. So if you actually get growth in your investment, obviously, and if you're going to get growth in your investment, you want to leverage as much as you can, given that those factors. So if your real estate appreciates, the leverage is actually better for you. It does provide you with more volatility in the event of a downward market. But for most people who own their real estate, if you're not selling it today or tomorrow and you don't see the value of it, on a day-to-day basis, who cares if it's up or if it's down short term, right? For most people.
Right, exactly. Keeping that long-term perspective is important.
Yeah. And I think the second thing you said in your answer there was physical asset, right? There's a difference in people's mind about owning an actual asset physically and taking care of it and making sure they got good tenants, and which kind of leads to paying more attention to your asset and taking better care of it, and therefore generating better returns. Because you're a lot more likely, if you're going to see 20 buildings and buy one, you're probably going to get the absolute best investment. And you're probably going to, if you spend a ton of time, if you devote a ton of time to finding the best investment, it's going to be better than just passively putting in a publicly traded REIT, I think. So I think I would agree with both of those points.
Yeah, you summed that up perfectly.
Well, you said it. I just summed it up. So if we were to look at some tips, so give me some of your best tips for young adults out there, or any adults out there, into growing their wealth. What would you tell your clients, or would you tell your viewers on your YouTube channel?
Yeah, I would say invest as much as possible as early as possible. It is so important, and I've seen this in my own life, because I was such a big saver when I first had my career and was making extra money and things like that. But I did not see the value in investing and taking just a minimal risk and having huge returns. So the earlier you can get started investing, the better off you're going to be. And you can you can start very simply, and you don't have to have that much money to invest. You can do it very simply in the stock market. You don't even need to start in real estate, but just get started. So I would say that's my number one tip, like invest as much as possible, as early as possible. And I would also say, know what your goals are, have that long-term mindset, and set some really specific financial goals for yourself. Whether that's just to, buy your first rental property, or even just, start investing and have $1,000 invested, whatever it might be, but set some really specific goals and work toward those goals. Because if you're working towards something, money becomes a lot more exciting, and you want to learn more about it so that you can actually accomplish your goals. So those are two tips that I would share today.
Nice. So people that are approaching retirement, then do you see a lot of people? Do you deal with a lot of people that continue to add to their real estate portfolio into retirement? And then my second question for you is, maybe I'll let you answer that one. No, I'll ask you both of them right now. What allocation would you recommend your viewers have towards real estate, privately owned real estate, and towards publicly traded stocks?
Okay, so with real estate, you know what? With older people that are retired, I haven't seen them purchasing as much real estate, but they're not selling it either. So I feel like when they're a little bit older, maybe they don't want to take on as many properties or have to worry about managing all of those properties. But that's not to say, even someone in their 50s or something like that. I've still seen people around that age investing in real estate because it's such a good investment. And I've heard a lot of people say, "Oh, I wish I never would have sold that property." Uh, so I feel like when people are kind of more in the retirement age, they don't want to be handling as much real estate, so they're not continuing to invest in it. And then as far as your
Allocation.
other allocation, thank you. So for a lot of my viewers, they're, I don't know, probably around like 25 to 40 or something like that. So for me, I have about 70% of my investments in real estate, and then the rest in the stock market. And that may, I don't know, sound a little high to some people. So if you're just getting started in real estate, start where you can. But I really like having the majority of my investments in real estate just because that's the main thing that helped me achieve financial freedom. And I feel like that can be the investment that helps other people become financially free at a young age too.
Yeah, I think the advantage to having investments in the stock market are obviously the liquidity, right? So you want to be able to have liquidity. You want to be able to convert that to cash so that if ever you do get another opportunity down the line to buy real estate, you have that ability. I think what you don't want is a situation where you're so leveraged, you're so tight, everything is so tight that you don't have any other capital and everything's in your real estate, and then you actually can't do anything else, and then you can't actually, you can't pull money out. So I think you definitely want to have some liquidity. You want to make sure you're able to access some capital. And remember, when you're buying these companies, if you are buying companies, a lot of these companies that are trading are growing their shareholder equity at the rate of 12, 13, 14%. So, your rule is 72, you're doubling that every 6 years. So you mentioned earlier, start early. Like if you start at 20 instead of 32, well, you only need to save a quarter of the money than you do because you've doubled that money, right? You've doubled it twice. So if you're doubling every 12 years, if you're doubling every 6 years at 12% or 6% every 12 years, it gives you a lot earlier, a lot of a head start. And it just does wonders for the balance sheet for young adults. By the time they're 40, next thing you know, they've accumulated all this wealth if you started early, right?
Right, exactly. It's so important.
It's a great tip. Okay, I'm going to pause here. I'm going to just remind our viewers, if you're watching on YouTube, Facebook, LinkedIn, whatever, please make sure to follow, like, subscribe. If you'd like to book a no obligation consultation, please go to speaktorob.com. Tiffany, anything else you want to add with respect to anything that we didn't cover today that you'd like to mention to our viewers?
I think we covered a lot of great stuff, and just, yeah, like I said before, start educating yourself about your money and invest as much as possible as early as possible.
All right. Words of wisdom, truer words of wisdom have never been spoken. Well, they probably have been spoken, but great advice by Tiffany. Thanks so much for taking the time today, Tiffany. Guys, thanks so much for tuning in. Really appreciate it. Glad to have you on here. It's going to be a busy couple months. I think we still expect volatility in the market. We're not done yet. Expect to see some volatility as some potential bad news comes along, or as we see some instability on the election front, or as we see that January 5th runoff for the Senate. If it somehow flips the Senate, that would likely not be a good end result for the market. So all of that's still coming. Stay safe with COVID. And thanks so much, Tiffany, for being on the show today. We appreciate you taking the time.
Yeah, thanks so much, Rob. This was great.
All right. You guys have a great day, great week. We'll see you next Monday, same time, same place on the Tetrault Show. Have a great day, guys.